By now, we've covered all the aspects of profile, so you know different profile plays, you know what the shape of a certain profile means, you know what an initial balance leads to in different types of day types. This way, you're able to provide or give yourself a sense of sequence that following a certain type of day, you can expect a different type of day. For example, following a trend, you can expect a balancing type day. Following a liquidation day, you can expect one of two, either direction or reversal. So you've got a clear idea of using the information from yesterday and sort of being able to balance that up and saying, right, well, this leads to this. What we're going to look at with mapping is creating a longer story, building up the picture over time. So that this way, you're not just taking on the information from yesterday and acting on the basis of that. You're taking on the information from yesterday, balanced against what's preceded that as well. Asking yourself, well, has yesterday changed the story at all from a technical perspective? Has it shifted value? Has it stretched the market out? What has it done on the wider perspective? So what I'm going to look at then in mapping is mapping the story of the day and trying to balance up your skew within the day. Then we're going to move on to looking at weekly profiles. One of the most important things at the beginning of a week, get a sense as to what's potentially there for the week ahead. And then we're going to finish off by looking at the building up of this story, looking at an example in gold over the course of a month and the story developing and giving you a sense of being able to then prioritize the value of information and understand whether anything has really changed or not. So, as I just said, it's all about building a contextual story. So how are you going about doing this? Well, one of the main ways of building a contextual story is understanding priority, understanding what days have been the most important days. For example, you have a large sell-off move followed by a massive tail and value left high on that day. This could well be a very, very important turning point. Therefore, that profile has priority. It changes the narrative, it changes the direction. And so now, rather than you just looking at the next day and asking yourself, right, what does this mean? You're now looking at the subsequent days in terms of them being able to suggest that if this is a reversal, all of those are really adding up to confirming the reversal or detracting from it, rather than you just trading day by day by day. This way you get what I'd call a lead profile. And this is the profile that until a change occurs, this profile holds the key to direction. Of course, the value of that can be diminished over time, but you're always trying to weight yourself towards that and then leading on from there. What mapping also does for you is allows you to time yourself. It allows you to time your expectations. So if you're sitting in the middle of a very stretched out previous week, you can be looking at this day and the week as a whole as a week where you know that maybe there isn't such a high expectation of movement. This way you avoid traps of getting caught up with what the recent movements have been. Expecting that after a recent breakout, we're going to see continuation. This may not be the case, and you can understand why. So it allows you to time action. It allows you to look at a market and say to yourself, there is scope for movement here, and I'm ready to play it. So in a sense, one of the best things about mapping is it allows you to align yourself to certain days and sort of say to yourself, today is the day for me. If I like a trend type move, if I like a very directional market, you may be able to look at the sequence of action and say, this is the day for it. This is the day where that big opportunity is going to come. So you don't have to try and play for something that's not available on previous days. We'll talk a bit about understanding auction health. And as we get more into order flow as well, you start to build this story up even better. So order flow helps you understand this. But what you're considering with auctioning health is within the day, you're watching it, of course you are, and that helps you build the story up. But within the day, you get a sense as to how the market's been trading. A poor auction, or an unhealthy auction, if you will, is an auction that isn't doing what you expect it to do. In the sense that, yes, it may well be moving higher, and that's the expectation, but the way it moves higher is not convincing. It's slow, it struggles, it has lack of volume, it has lack of pace. All of these things add up to build that story about the auctioning health. So we'll touch on this a little bit more. You can see how the market does when it trades up, when it trades down. You can see whether there are certain patterns coming in. You know, the one time framing pattern that we've talked about previously, good example of a poor health auction, a market that steadily auctions higher, doesn't ever really drive on, and that becomes a weaker market and is susceptible to a reversal, but directionally it seems strong. And this is what I mean by looking at the auction health to build that story up. First up, what we're going to go and cover is pattern conviction and a way of trying to differentiate this. This allows you on any day to look at the information coming in and balance it against other information. You remember, trading is not a job of being able to talk in absolutes and say, well, this happens here, so therefore this will happen. One of the other key things we're going to look at is differentiation and pattern conviction. What I mean by this is scoring the information that you're gaining on the day. This way, you're building up an understanding of whether an idea or a move that is currently on is actually still got potential in it. And you're trying to balance the information incoming. You're not trying to say, well, I've seen this pattern, so absolutely we're going there. Trading is not a business of absolutes, it's a game of uncertainty. And what you're trying to do is take information throughout the day to build a clearer picture, a picture that is more likely to play out. That's what you've always got to be thinking. What is more likely to come from this? That way, you can rate the quality of movements. You essentially can give yourself a score whereby the information coming in, the stacking up of that information says you need to trade now. I'll give you an example of this, and this is where we're going to start. Right, short-term conviction mapping then. This is what you're going to be doing on an intraday basis. And this begins with the start of your day. We'll be doing more and more on this in hypothesis development as well. What you're trying to do is create a comparative judgment. You know, never try and say this will happen. But you're trying to take the information that you have and say to yourself, right, on balance, this leads me more towards one direction or another. And the way that I've tried to look at this, it comes from a card counting idea. For anybody who knows how to play blackjack, you understand the basics of it. If you look up card counting, there are simple methods to do this. Essentially, the idea of card counting is you assign a score to different cards. Once your score shifts in a certain direction, this indicates that there are more high value cards in the deck. And so therefore, as you get a higher positive score, this says you should bet now. Very simple, you weight certain cards on different numbers. And what you're trying to do then is apply this to trading. Like blackjack, like any game, there is uncertainty in the outcome. Even if something is more likely than not, you can't be certain of the outcome. So what you're trying to do is you're trying to look at the information on balance, say, well, it's probable that this is going to happen. The more pieces of information that lead you down that path, the more and more probable that becomes. Simple way of looking at this. So it allows you to discount one against another. You essentially value each piece of information, positive versus negative, and tally them off against each other. What's very, very important in doing this kind of analysis is you have to have clear metrics. You have to look at things in the same way. So what I mean by this is you have to compare the same information. Each day you have to look at where you're opening. You have to look at where you're opening relative to the previous day's type. So each of these can gain a score. Opening above value may give you a score of 1. Previous day type being a balanced day also could give you a score of +1 or -1 dependent upon where the open is. You can look then at overall direction to give you a score. You can look at the open type, the type of initial balance, but just make sure that you're consistent. Whatever you're measuring, be consistent in what you're measuring. That's the important thing here. I don't think it's, don't try and use this necessarily as the thing to do. Be consistent on how you do it yourself. Measure the same things. You can always add to these things. You can always take away from these things, but always be consistent in what you are comparing. What you're trying to do essentially is stack up a score for each of these. So you may have +1, +1, +1, +1. This way you've got yourself a +5 score. Once you get a score that is high enough for you, there's no absolute score because everyone's going to compare different pieces of information and everyone's going to be willing to go on a higher or lower number. So don't try and, nobody's going to be able to give you an absolute. You need to be able to judge this over time and say, right, once I get a score of 5, I'm willing to go for it. And as that score goes up, you can then add to your position as well. This way, it takes the subjectivity out of things, makes it very objective that as your score goes up, it's essentially saying to you, you need to add to the trade. And that's a great way of doing things. It takes hesitation out, it takes all of the other stuff out, the overthinking, and it's just you have to get involved because everything you've written down, all the information you have, tells you that you have to be involved. So let's go and have a little look at this in action and how you would look at this at the beginning of any day. So, simple bit of information. This is looking at the pound. This is just picking any day and going, right, the pound at the European session open, so this is 8 a.m. in the morning. What information do we have? And simply stacking these up into a bullish column, a bearish column, and you can balance the two against each other, giving you a very simple +2 if you look at this from this perspective. What you've got then, you have a double bottom. So from a pattern perspective, that's a bullish pattern. Also, the double bottom is broken. So this is a confirmed double bottom. It's not speculative. If you were trading here, I wouldn't call this a double bottom. I would suggest that trading there, possibly a double bottom, but you're only going to get the +1 that goes there once you break this high. Once that's gone, absolutely, I would give that a score of +1. And this is the bit that you have to decide on how you're going to score this yourself. The close from yesterday, or the type of day yesterday, neutral extreme, close towards the highs. There's a bullish tip as well. We open above value, bullish tip. Delta has been positive on all drops, bullish. So there you go, you've got 4 bullish pieces of information. But you have to balance this against the bearish. General direction is clearly down. The last 3 days, 4 days even, the last 4 days have come off and you've had 1 day of consolidation. This then isn't a massive surprise. So general direction is down -1. You've got single prints providing you resistance, minus another one. That could be the limit of any kind of movement higher. So this way you've now got yourself a little bit more picture as to how much you can really believe in this market continuing towards the upside versus the downside. And you can then add on to this, and this is what I mean by building up your score throughout the day, and this over time adds up into your longer story as well. So if you've seen day after day after day that finishes up with a high positive number, then this is maintaining a very bullish market. Whereas if you just look at day to day, you then only judge what you saw yesterday. You only judge the bit of information you gained from the beginning of the day. Whereas if you've got this cumulative positive score going forward, it may well be that, yeah, maybe yesterday was relatively neutral, slight positive score, but this just stacks onto an already very positive market. So you try to look at it like that. So let's take a little look at this one. Different market. So this is one look at S&P now, and looking at information at the beginning of the day. You've got a rejection tail down here. Good stuff. You've got an open above value. More positive news. And you've got a poor high. More positive news. So we've got 3 on the bullish side at the beginning of the day. Arguably, you've also got this responsive test if you're looking at the IB, but if you're just coming in at the open, from the open, you've got the bad high, you've got open above value on the back of a neutral day and a tail, which adds to the bullish side of things. Bearish story, we have just followed a drop, and you've got an inside day as well, which opens up the possibility of a move down. But aside from that, there's no other majorly bearish information here. So what you can then start to do is, as the day runs on, you can add to the information. Your score can increase, which can be your reason to want to take a trade on. On the basis of a +2, you may not want to be getting in. So buying the open is perhaps not the ideal trade here. It allows you to then hold back, no matter whether you think, yeah, this can go up or not. So then information starts to come in. We open, we trade down to the top of value, we test value and bounce. Brilliant, there's a +1. Oops, there's your +1. We break the initial balance, another +1. In breaking the initial balance, you get the low volume node through the poor high, another +1. So your score is now going up. This is the point where you look at this and say, yeah, now I can get in. We're now up to a +5, which is saying to you, get involved. You're also at a +5 where you have a very clearly defined stop back inside the IB. Wonderful. So now you've got yourself a situation where you can buy it, you have a clear stop, and you've got high conviction that this is going higher because the score is continuing to build up. And so that then brings you in, basically at this point, you're buying it around here, looking for continuation towards the upside. So on the back of all of this information, we get then an inside daybreak, we do single prints, all of these things, more and more good news. However, the story does start to change. You have a liquidation. That's this very fast move. That's the single prints. So whilst the single prints provide you a bullish argument, these are then reduced by the bearish argument of the liquidation. Now, the reason I've given this a score of -1 is that a liquidation absolutely is sending the market up here. However, what this does do is detracts from the ability to continue onwards. All of the rest of this information still stacks up to a market that should go higher. But the liquidation move suggests that there are less people to continue pushing this higher, and so therefore actually detracts from the score. We run into resistance as well. You've got previous low, you've got single prints. You're starting to hit up onto resistance, another minus. You also have delta, which throughout this move up has actually continued to fall, another minus. So what this is enabling you to do then is it's basically just from scoring this saying you need to reduce your position, get out of your trade even. Because your reasons for being in the trade as you come up here We'll come down here, 3, 4, 5, and now reducing back down, 5, 4, 7, 6, 5, 4. This is saying to you, get out of the trade. Take your profit, bank that, move on. Wait for your score to change. Is it going to increase back up, in which case you can get back in on a breakthrough highs? Is it going to reduce as you fall into single prints further? If it starts to fall down, then you can play on the acceleration of that drop back down. And so then the progression continues. We're up to here on the delta, but note now that the resistance holds. So we had a -1 on the resistance to start with, but the resistance holding, which is here, gives you another minus. So same piece of information, but the resistance holding gives you a -2. Delta continues to fall. You get a false break. The false break is very significant now because of the fact you've moved up, false break higher, that gives you a -2. Delta continues lower, further minus, so we're now down towards 0. And then when you fall into the single prints, you're already seeing that the story is very much leaning towards the bearish side, and if falling into the single prints gives you another -2, you actually now flip to negative, and this then allows for the move down. This is a great way of being able to sort of change your perspective, change your mind. That even come the false break, you're already on a reasonably low score anyway. You're sort of 4, 3, you're ready to get out of this. When that false break comes, absolutely you're getting out of the trade. And by doing this, you're allowing yourself to build up this story throughout the day, which helps you differentiate the value of certain pieces of information. What it also does is by the end of the day, you can see the score throughout the day. So you then have an easy way of comparing day after day after day and continuing this ongoing scoring, ongoing perspective of the information that you're getting coming in. All right, so we just looked at building up your conviction throughout the day, sort of scoring each day. What I want to now do is take that intraday kind of analysis and view and building this then into a sequence of days within a week. So what we're going to look at here is a market that has already come off, consolidated, and then what happens over the forthcoming week, taking up that information throughout the week and building up your story, building up that contextual narrative, rather than just looking simply at day-to-day basis. So to give us a little bit of backdrop to this, this is where we are. So on the left, I've got a daily chart. On the right, I've got an hourly chart with the profile of the previous 2 weeks on it. This is in the Bund. This is going into the beginning of March 2022. What we had, very significant sell-off since Christmas, bounce back. This was going into the Russia-Ukraine war and a hunt for collateral, a hunt for safety. People go rushing into that, they buy bonds, which is what creates this ramp up in bonds. Very quickly though, this then turns over. The ECB partly averts this issue as well themselves with various liquidity measures, not something that needs to be discussed right now. And this then leads to this sell-off. This move down here is this move here on an hourly across the week. Now, as we know, from a profile perspective, this looks like a classic trend type move. Constant shifts in value, broken up by small, low volume pockets. Classic trend. What does typically follow a trend? A balance. The following week, we get exactly that. Completely sideways action. So after having dropped from 168 down to 162, so 600 ticks in a week, we then spend the rest of the following week, realistically, you take out the very early drop at the beginning of the week, in around about 100, 130 tick range. Tight. Building up volume, building up energy, this market's ready to move. So we've got that context. Coming into the next week then, beginning of the following week, you're looking at this thinking, there's scope for a move down. Following on the overall bearish narrative, this market can go down. So you're inclined towards that. And the fact that you had a balanced week also suggests that you have the scope to do it early on this week, because the fact that we've already balanced this out, the market's ready to go again. So this brings us on to the first day of the following week. This is the bottom of that previous week, giving you a clear point to break out from. Essentially, the lows of the range were formed at around 72. You had the spike lowest point of the previous week comes in at 56. So you know the points where the breakout can come from. Timing wise, your expectation is there that if you get any hint of this early on Monday or at any point on Monday, you can go for this. So we get the consolidation. The trend tone starts. Drift down early on, down towards that 72. Once you get this punch through, and it comes later on in the day, in fact, we start to build early in the morning. From midday, you get the smash through the low, light volume, shifts value lower, everything you want from another potential trend day. So all looking good here. Where the problem lies with this is then that final move is kind of a shot down into the close, and then much of the volume accumulated down here and time spent down here is done post cash close, thereby making this part of the move from 160.10 downwards somewhat questionable, this bit down here. Nevertheless, market has clearly shifted lower. This is a pretty solid red candle on a daily, and you've broken out of a previous weekly range. Overall, the story continues that this is a bearish market, and we can continue to look for movement further towards the downside. The following day then, on the back of this trend move, this also allows you to build up the story and ask yourself, right, well, what needs to happen the next day? If this is to maintain its ability to drop, you want to see one of two things. Either you get a second day trend move, or we get some degree of consolidation, acceptance of value at these lower prices. So that's what we get. We get an acceptance at lower prices. We open with a gap down, trade back up, that's this move here, test back into the previous day's range and reject it. Clearly, sellers are still in control. This is good news. This keeps that story going, that this is a market that is quite comfortable going down. It's what happens next, which is where people can often get confused if they're not continuing to look at what's going on. What happens down here then is you have a very clear sideways consolidation. Sellers are still pretty keen to sell, which is why you create this resistance here. And the fact that it is a very clearly defined resistance is showing that any bounce back, people are just holding this. You've got a lot of passive sellers here creating this very, very obvious responsive level, 52 to 57. That's this little box here. So this now starts to build up a picture as to what's going on. You have responsive traders. These aren't the initiative traders that drove the move down. This is responsive action. This is people now realizing they're going to have to move their offers down if they want to get filled, and they're all moving them to approximately the same area, around about 59.50. This creates a completely balanced day. So bar the early move, complete balance. That maintains the overall direction. So if you think about building this, what's leaning towards continuing, what's leaning towards reversal, continuation very much is there, but you can now see how a reversal could come out. If everyone's sitting here selling, and look at the delta, huge amount of selling here. There's a lot of people after the first move that are now coming in to sell passively, and they're still quite aggressive selling as the market has consolidated sideways, but they've not got the continuation. You now have a lot of people at risk of a reversal. And this is where, from a day-to-day perspective, there's a trade opportunity, but this doesn't change the whole narrative, and this is the important part. Overall, bearish, but you can see how the reversal could come from here. You've got potentially a lot of trapped sellers, and unless the next day you get more people come in and sell it, you have a lot of people who are going to be disappointed and maybe forced out of trades. Note that volume on this day is bigger than volume on this day as well. So again, another indication that you're getting a lot more action down here and no movement for all of that action. So moving us onwards then, what comes the next day? Is there any surprise that you get a liquidation? Absolutely not. And I think that's not something new. You know, you could do that just purely off this profile. But because of the directional move, people can then sort of miss that, and they think, well, values continue down, look for the continuation down, and they switch off to this break towards the upside. From the weekly perspective, you've got a very clear cave of volume as well. So this is the profile over the 2 days, Monday, Tuesday of the week. You get the liquidation move up. Once that's happened, you're above 52. On this day, your overall view is this is a market that can bounce now. And as long as you hold above 52, you get the continuation with a very easy target up towards single print and then VPOC from the previous or from Monday. So it's just a pullback up the range. And this is all a very responsive market now. Market is reacting off very, very obvious reference points. What does this tell you? And this is the bit that I've talked about with auction health. You need to look at this and say to yourself, well, and I've talked about this earlier with profile stuff, the market that reacts off obvious reference points is generally a market that is led by shorter time frame traders. They're the people who see the obvious levels, the references from previous. They trade them and they get what they want, which therefore shows you that there's nobody else pushing against these. So this, in the way it trades, the auction health here indicates that this possibly is short-lived. And you need more information and more trade for this to be something that lasts a significant amount of time longer. Therefore, it's a doubtful move. Remember, Delta was still very heavy the previous day. This is a reversion back through this area of low volume, filling that in. Doesn't change the overall narrative that this is clearly a very bearish market. Which then opens up the next day. For many people, the obvious thing the next day is to think, right, we've started to reverse. Yes, you have a caught in the hole situation. So going in, just looking at the end of this day, you can look at this thinking, right, that's quite a reasonable drop. And then we might fill a bit of volume in here. And that's quite reasonable to see. But because you've understood the story up to this and you know that there is a lot of selling down here, and notably, that selling hasn't really come out. This is minus 18,000 in Delta. This is plus 5,000. So that selling hasn't been really reversed. It's just a bit of short-term bid up, few traders liquidating, but no one's really changing their view. Therefore, if you're a longer time frame trader and you've been selling this for the past week or so, this is still well below the previous week's low. And so is now really a chance for the longer term traders to just sell as it rises. And that's what's going on. That someone trying to accumulate a position, they did have to be more active down here and more willing to sell towards lows. Whereas when you get the quick liquidation up of the short time frame traders who are very responsive, it's easy for a longer time frame trader to just sell and keep selling there. They're happy to just sit and get filled. So think about it from a time frame perspective as well. If you're a longer time frame trader, you don't need to be active now. But if the market starts to come off, you're going to have to change the way you view this, change the way you transact, change the way you trade. And because we've understood the way the story's built up, for many people, seeing the market open here, they would think, right, well, the caught in the hole trade's gone. Okay, so they forget that. We then look for the possibility of holding inside value and a move higher. We do get a bit of that, and it just trades straight into the previous day's value, and we start to come off. But not many people are going to be looking for the possibility of a drop through this area. You've got VPOC, top of value, this whole little responsive trade area. If you get a push through there, now you have the potential for a shot towards the low, for a sweep down through this value here, which was formed on Tuesday, continuation of that selling. This is what then allows you to be willing to play this type of move. Even after having seen it, bearing in mind to get down to 50, this is around about a 75 tick drop. So after seeing it go 75 ticks, many people won't be keen on trading that. But it's what's happened leading up to this that says to you, you know this is responsive trade. If those short time frame traders don't stop it again, now you're going to get the sell-off. And it's exactly what you get. When the sell-off comes, you get very forced selling. This comes from seeing it trade on a ladder. This was a move that felt relentless on the sell. There was no real bounce back. Every push down, little tick up, bang, push, little tick up, push, little tick up, push. Relentless movement. That takes us down. You get the breakout. That's where the acceleration comes from. That's what drives this move down. Delta continues onwards. But it doesn't continue. And once again, you get this very responsive trade. Using previous references, 07 to 04 now becomes your obvious point. Creates a very, very strong or obvious ledge and a decent tail. This now again brings you to this idea of, right, well, we've now got potentially a reversal or an end of movement based on the tail. However, you can see where the opportunity is towards the downside. Once again, from a auctioning held perspective, it's very responsive once more. And you see that these responsive traders, when you get back up above a previous reference, are willing to just flip that reference straight back to support. As they did here at 52, they do the same down at 07, 05. What we've done from a weekly perspective now is balanced out. Story does suggest we're more bearish though, looking at the way that every move up is more of a liquidation. People have got themselves stretched higher. Overall, the trend's down. Delta is much more obvious on the downside. Delta minus 15,000 when it drops. First day of the week. Okay, not massive, but it's around about minus 5,000. The only positive delta has been positive 5. So you can see the significance. People are still very, very willing to sell this. So you then got to take on all of this information and build this into your story for the next day of the week, the final day of the week. What we get here then, if you think about the way the market's traded, every move up has only really been due to liquidation. You get this move up here, liquidation. bounce off the low, flash down, quick liquidation. We hold 07, liquidation up. And that's what you're seeing from here on the profile, this single print charge up early on. So this means that your bearish bias is still there. You're overall going to be more inclined to try and sell than you are going to be trying to buy. And if you are going to buy, think about managing expectations. You're looking at a buy, which is going to be short-lived. You're looking for the fast pop, pop, pop up, nice quick zip higher. You can use that. You can take those trades on. And often they're the trades that are faster, as we talked about with liquidation times days. But they're not going to be long-lived. They're not going to be a day that you can expect to trend and trend and trend. And as long as you're aware of that, you can take advantage of it, but stay in control of the overall context and the overall narrative from a profile technical perspective. So we've got various references to consider. Again, looking at it day to day, people will forget certain references as well, like the 52s area that we traded from the previous couple of days. That's your first area to be watching. It's not just because we dropped down there. And if you just look at this, there's nothing significant about 52, but it's the references that you had over here. It's the way that it zipped through it. It's the responsive action that you get there. You've also got that ledge, so you know that you've seen, once again, more responsive action down at the lows. If that doesn't reappear, same principle, same trade that you take here can apply here. With the expectation this is going to be quick on that break because you've got this clear previous template to trade this type of move on. And you get it. The next day, you get quick liquidation early on in the morning. You get the smallest IB of the week. This is great because this is saying to you the scope for movement straight away. So you're looking at this from a day-to-day basis now. Overall, you're bearish. Overall, you're thinking as long as we're staying down in this little zone here, the 60 to 07 area, we're looking for the move down. You get the quick zip up, that's fine. And then as soon as we start to turn back, as soon as you start to fall back into the single prints, back inside the IB, that ledge is a target. And because of the way you've seen it trade throughout the week on sell-offs, you're ready for this. You're ready for that continued move down. A bit of news helps. And in this case, you get a call for 3 50 basis point hikes from the Fed in 2022. Prior to this, most hikes were expected to be 25 basis points. We were now calling for 3 50 basis points, basically shifting rate hikes further forward, closer to the current period in time. This creates a sell-off, but this is a move that's ready to go anyway. And it's the build up to this that gives you the conviction and the confidence to be able to play that type of move. That's the value of mapping a story out. That's what stops you from getting caught up overweighting this day in particular. This is a day that you can treat with some suspicion. It seems that it's liquidation and then very much held by short time frame traders. That's not what you're really looking for. And that's something you can doubt, particularly when you look at Monday, Tuesday, the delta, the volume, all of this stacks up to this being a sort of squeeze, short squeeze, and the move can then continue on the next day, which is exactly what it does. So that's how you want to go about trying to map a story from a day-to-day basis. This then also builds into your weekly story as well, that you can then see how this week has fared, how value shifted on the week, and over the course of this week, whilst from a day-to-day basis it provides opportunity, over the course of the week it does slow the action down. Bearing in mind, if you went back to the first profiles that I showed you, very clear trend, consolidation, you're looking for another trend. We don't get that. More, you get a kind of fat bottom Christmas tree than another trend week. So this is then, as the move from a wider perspective is continuing, we're actually then losing strength. We're losing that bearish nature, despite the fact that day to day it has provided some very clear bearish opportunities. We're losing that perspective. And that's what I mean by continually building up on this story. Right. So that's then we've moved from intraday, dailies. Now I want to go and have a little look at weeklies. What you're trying to do for a weekly is to give yourself that slightly wider perspective. With this, it's not necessarily about being able to define what you're going to do today, necessarily. It's about trying to define how you expect the market to move over the rest of this week. Do you have an expectation that we can move a great deal? Should you be expecting a reversal? Should you be doubting how we've got to where we've got to? So the main reasons that I'm using a weekly profile is you're trying to look, like I just mentioned with that previous example in Boone, you're trying to gauge the move's quality. So you're trying to understand whether this is a sustainable move. In the same way that you could look at a caught in the hole on a daily basis, you could look at that from a weekly basis. You can look at a balanced week as we had it with the Bund and that breakout. This way, you build yourself this expectation of whether a market can really put the move in that you're looking for, whether it is going to get dragged back first. And so it prevents surprisings. And that's one of the main things for me, of being able to not be surprised by something. Because if you're surprised by something, you don't know how to react to it. And you then have to work out what to do, which creates a period of hesitation, of doubt, of trying to work something out on the fly. You don't want that. You want to be clear on what's going on. So you can then start to understand whether we may need to trade back, where the market is going to get stuck, where it can accelerate. And like I said with that previous Bund one and this, you don't overweight the action. The easy thing to do here, if you look at this from a weekly candlestick, this week here, so the first week, there's 2 weeks here in gold, again, using an hourly chart with a profile across them. 2 weeks here in gold, this is a very solid week. From a weekly candlestick, we open virtually at the low, close virtually at the high. But if you look at the story of the week and the weekly profile, it gives you something different. We've actually spent much of the week trading down here. You look at where value is, the red lines, this is a market that hasn't really shifted value higher, yet puts in this big end of week move, caught in the hole, essentially on a week. Now, it doesn't lead you to a trade in quite the same way that a daily does, but it leads you to an ability to look at this and think to yourself, until we spend some time accepting value higher, this is not a market that is going to continue. We need that. If it can't accept value higher, then we get dragged back down here. So it allows you to form a little bit of frameworks and parameters with which you expect the week to trade within. Once you've done this, then the story can then elongate, and you look at this and you think, right, well now, after the first 2 days of the week, which trade like this, now we have put some volume in lower. Now we can look for a movement higher. If you're looking for the continuation, which is now becoming more and more clear and more viable, now you can play for it because we have shifted value up. So over these 2 weeks now, you've essentially got value down here and now value building higher. You have more of a longer term trendy move. Now you can look for breakouts. Now you can look for continuation. So it comes to Wednesday and Thursday where you actually get the move. And this isn't a surprise if you're looking at it from a weekly perspective. But from a daily perspective, playing this, break through the previous, through the Friday high, creates a very choppy move. The next day, we trade up and we fail and roll back down. And this is where people get themselves in trouble because they haven't looked at it from a weekly and realized trending straight up from here is probably not that likely. And until you can accept value there, it's not going to go. Once you get this little pocket of volume, now you can expect the move higher, or the pocket lacking volume. This does create a sustainable move. This does shift value up. This maintains a continued trend type move. And so therefore, at this point, you can be confident that gold can continue higher and you don't change your mind to the downside until you're through that box. That's what a weekly does for you. That's how it can manage your expectations day after day after day. Time your week essentially to be able to say, right, I can go for it early on, or I need to wait for something to happen. And not to try and time day to day when something will happen, but just to be able to be more leaning towards the beginning or the end of a week as to when you expect the more directional movement to come from, or whether indeed you expect no directional move at all. I'll give you another example. This is a series of weekly profiles. Now, I don't think you necessarily need to use a weekly profile. You can, as I showed on that previous one, just draw a volume profile across your hourly chart. This serves the same purpose. You're not trying to use it to pinpoint precisely where you're trying to trade. You're using it to gauge a sense of where value is established on the week, how value is shifted within the week. Because over 5 days, and if you go from Monday to the following Friday, 10 days, you can lose a lot of information between those 2 days. If you look at a candlestick chart, there's so much space between the two that often a lot of information becomes lost. So what we have here then, and I'm going to show you this on a candlestick as well in a moment, because this then makes it quite obvious. And this is where looking at a weekly helps. What you've got then, the market that opens higher on this week, and we trade up. Straight away, we end up with this consolidated move. But this becomes quite obvious when you look back at your weekly profile that you've had 1, 2, 3, 4, 5 weeks of value all established lower. We move up. into an area of no volume, limited value from 5 weeks prior. And this then caps the market, creates the top of the range of the week, forms much of the base of the range of the week, and incidentally was also the high of the previous week. So you can now go into this understanding why we're trading up and down in this range. But more to the point, and this is very clear when we look at it from a candlestick chart, you're not surprised by that move on a Friday and can even take advantage of this. For many people, that's a massive surprise, which catches people out after them becoming very comfortable with a market trading higher, increasing people's view and expectation that we're going to continue higher. False opinion there, because there's actually more scope now for a reversion back. And this is what I mean. This is that first week, so you do week 1, 2, 3 on here. This is week 1, 2, 3 on here. And you see, similar to that gold reaction, balanced week with a late Friday move. On the day, this is great. This is a decent, strong, trendy type move. But on the week, this is not so strong. You come in on the Monday, so this is the Friday move, you come in on the Monday and you get another trendy type move. Really strong looking market. This is where people overweight the most recent information. Value is still left down here. Think this day followed by this day is just going to create one long stretched piece of value. After that, we don't get any continuation because of the situation moving into 5 weeks prior. We get consolidation, we get a pullback. Value starts to accumulate higher. So at this point, we're okay. This market can continue towards the upside. But by always being aware that this was one-off move late on a Friday, drag away from value. If you start to fall into that, it's not a case of this is a chance to buy the dip as we come into here. This is more a case of this is acting like a magnet back towards previous value. And that's the bit that people miss. Yeah, this move comes a full 5 days, a full week later. That's what people forget about. And they become accustomed to the trade up here. And the assumption is that this is now a bullish market and we can look for a continuation towards the upside. Not going to be the case. Instead, what happens is you get a gap. When the gap comes, this creates a liquidation. People are trapped here. People are trapped here looking for movements higher. They don't get the chance to get out, the market gaps, and you get this very fast early liquidation. So this entire move is done within the first couple of hours of the day. This catches people out as well. They don't take advantage of it because they're not aware of or haven't considered the weekly perspective over here. They miss the trade, they then end up spending the rest of the day trying to make money in this zone here. Complete chop. They get chopped up trying to play continuation, trying to play a reversal, all of these different types of trades, which are just not suited to this type of day. And that's all down to having your weekly understanding. Building that picture up, and so not being surprised by action that comes later. In terms of managing expectations, you go into the next week as well, and what we know about high volume, we don't spend a great deal of time there. So you can expect the market to be quick through this zone, where you have essentially the value area from 2 weeks ago. Again, you're now getting 10 plus days away from that. People forget that. They don't have the expectation of speed here because they can't remember and they don't recall that because this is just a sequence of candles. Why should this be fast if last time we traded chop, 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 chop? People don't expect it. Yet from a profile, you can expect that when you're looking at it from a weekly. Stagnate down here, we then get quick back up. You can expect congestion. Look where this is going on. VPOC of this range is the low volume over here. It's light volume over here. And this is why you then have early in the week chop here, inability to just continue to trend up here. Market balances, and then you do get the drag back towards previous value higher. But this then serves to actually start to fill some of this zone in. That's where you get from a weekly. So it's so important. Like I say, you don't need to do loads. All you need is just to make sure you get a profile over the previous week, but on an hourly, it just gives you a bit of perspective. It gives you the ability to recall where the market possibly could go and not be surprised, more to the point, by changes in structure and changes in markets movement. The other thing it does for you is it allows you to plan trades out. It allows you to pick an idea early on in the week that's then waiting and resting for you. We talked about this with things like ledges and being able to hold on to an idea, wait for it to get to the ledge, and then you've got that trade. But that may not come for a couple of days, even weeks. Same principle here. And often what it can do is it can provide you with the cleanest, clearest move. It may not be massive. This is a simple example using Euro stocks on a weekly. You've got a really tight balanced week. You can see why it's balanced, because you're inside this area of low volume from the previous week and you're basically between two weekly VPOCs. So we balance this out. In doing that, we have now created a situation where you have a very tight range, tight value area. This provides an opportunity for a zip through. So you go into this week thinking, right, give me the opportunity to play a short into this value area. I can expect quick movement down, nice, fast, straight through this zone. And whilst it may not be gigantic, that value area range is around about 15 ticks, 15 to 18 ticks. It's not massive. But the fact that you can have conviction on it, you can be very confident in the speed and the straight line direction of the move. Yes, it may only be 15 to 18 ticks, but these may be the 15 to 18 easiest ticks of the entire week. That's where it's going to help you out. You get down there, you're ready for this. You see it gets to that point, you play it through, and it means that you don't have to be sort of trading every aspect and every part of the previous week. You know how to differentiate and you know how to leverage yourself towards those bigger opportunities. This is it from an hourly perspective. And this is how it then trades out. But sorry, not an hourly, it's a half hour. Just to give a little bit more sort of clarity on the chart. And this is what you get. First day of the week, not a great deal of action. Question comes then as you fall inside the range of the previous week. Once you do that, and you do it with a little gap down as well, straight away we're now starting to lean towards this trade. It doesn't mean the trade's on, but it means you can lean towards it. And you can start looking at opportunities to play it. What you then get are lows created just above the top of value. Top of value is 75, which is here. A couple of lows created at 84. Now you have the opportunity to play through those lows an earlier shot at this, meaning that you could be in 10 ticks ahead of value. So you're constructing the trade from the point of view of you can see where the action's going to come from, but from this you can now also see where you could enter this ahead of time, where you could be ready for this move to come from. And so you then get the acceleration down straight the way through the range, straight the way through value, straight down to 55, and you actually get a final little kick down as well through there. But that's the clean move, that's the bit that you're after. And all that comes from is just sitting back, taking a bit of stock of this weekly range. So if you don't look at the profile on it, you start looking at that thinking, yep, we could get some reaction here. You start picking out smaller levels in the middle, around there, around about those 75s, and it starts to look quite a tricky area. From a weekly volume perspective, this now looks very obvious and a very easy trade, clean trade to be trying to take on. What we're going to move on to now is looking at this sequence of events over the course of a month, prioritizing pieces of information, looking at how your perspective shifts in it and giving you the ability to then time a trade and the ability to look and think, now's the opportunity, now we can move. And this comes with false dawns. This comes and it will lead to some losing trades. It's not to say that this is foolproof, but what it does is it allows you to build the information up. Don't ever look at a trade that doesn't work from the point of view of thinking, oh, I've lost, that was bad. Look at it from the point of view of what information have I gained and how does this fit the wider contextual understanding, wider contextual narrative. That's what we're going to go and have a little look at. Now, we're going to look at it from gold, from the beginning of the year 2021, and look at the sequence of the first month or so in gold and the reaction that you get, the movements that you get there. Just take a quick break and then we'll come back. Look at this. What we're looking at here then is gold from the beginning of the year. First day of the year begins here and gives us this charge up. That gives you this profile. So for each of the slides, I'm going to show you the 5 profiles of the week, follows as well with the action on the week with a weekly profile across it. What you get then, early on in the week, you get move out of a previous range. This was the back end of December, reasonably tight, low volume range. Massive spike of volume, obviously, huge build up in delta. So you get this huge build up in delta, market charges higher and then grinds onwards. This is a classic example of what I would call a poor auction health grind. Market that jumps up and then it grinds. It's slow, it's steady, it dribbles on higher. This is something that you're doubting. But on the whole, we do shift value up on the first day, up on the second day, all looking good. So you can see where there's a potential trade. Easy, simple potential trade, break this little channel, wash back down, break back down through the early part of the week. And that's all good. So it gives you an opportunity. But on the whole, market remains reasonably bullish. You're still holding above the December range. We then put in this little pennant. Market's quite balanced, but does become a little bit more what I call 50-50. It could go up, it could go down from here. You could see how we can break through this range. You could also see how after the liquidation ban, the market can then just reverse straight the way back up. So reasonably balanced. You go into the next day thinking, right, we could do either here. This is the completely balanced day as well. So this stacks up to potential for further movement. Brilliant. You can then look, right, inside day, break either direction is going to give us some movement. And you get it. Breaks towards the downside. That's, you can see the top of the move just here. Sweeps the December range, consolidates and goes again. So we get this huge move down. This is around about a 900 tick drop in gold. So this very much sets the tone. This is clearly now a bearish market. There is an issue though. Value on the week's been left up here. So despite this being very high volume, and it's all, if you look at where the volume is on the drops. The high volume comes on drops, not on the market going up, but value is left higher. This then straight away leads to the conclusion that the following week may well be a more balanced type week. And unsurprisingly, you get that. But there's information to pick up here. Beginning of the week creates this fast spike down. So you get a big spike down early on in the week. That gives us a new clear low. However, I would not be viewing this low in quite the same way or view this as a full-on end of move liquidation type tail because of the time that it was done. There's the volume on it because it was done in the middle of the night. Light volume, less sustainable move. This low comes in at around about 1816. That's where the low comes in. So we've got that low established. And the market then for the rest of the week bounces back. We hold value up, continue to hold value higher, even when we push value higher into this zone up here, back towards the lows of that December range. We can't drive it on any further. And you see, from an auction health perspective, when you get up there, the market just runs out of steam. It trades sideways, it chops a bit, and then it rolls away. But it rolls away much more comfortably. You see the drops away here, you see the drops away here. All of this leads towards this view that this is still a market that is willing to go down, but currently is not finding enough sellers willing or even needing to come in and sell the lows. Instead, they're happy to just absorb any buying as it gets towards the highs. What this allows you to do is build up a picture as to how you expect the market to trade on a break. What we are seeing is there are some degrees of tails being created. That one less so because it's a tail created late on in the day, so it's less of a rejection. But there are some tails being created, notably here, coming in just below 1830. But you now can start to build an idea that for it to trade up, we need to see something different here. You need to see a market put more of a drive in when you get up towards these prices, as you start coming up above 65, which is the top of that little range. So here we go. You come into the next week and the following week, the same thing. Very, very early on in the week, slap down again. This creates a new low, which comes in just above 1800. So we've now got a new low. We've been down towards 1816. We've now got a new low down at 1800. You can see now, again, the same kind of idea. Market very quick though, straight the way back up. Value straight away gets sucked back up above 30, and that's this little bit of trade here. Market doesn't want to go anywhere. So with this new rejection, this will enable or lead traders towards trying to play the break towards the upside. Remember though, this is middle of the night rejection, not such a clear move. So we get the move up and you do break the previous week's highs. This was that little area where the market sort of chops and churns. Get up there and you get what you'd want to see. You get this fast, you get this fast move up. That's exactly what you're after. But you get no continuation. Once again, stagnation. Market sits up and we get the same repeat pattern. Does not have the impetus to keep on going when you get to highs. This continues that story of weak auctioning health at highs. Not a market that can find buyers. It can only find buyers willing to hold it on a drop and willing to push it back up when you get a liquidation. Sellers, quite comfortable to sit in the way, and they're also quite comfortable to push it down. You see the quicker drops. Volume again is still there when the market starts to come off. And so you then end up with, on that repeat pattern up here, this 2-day liquidation situation. So a market that can't hold on to the move up, gets pushed up, holds it, holds it, holds it, holds it, everybody gives up. And so what this is doing now, bearing in mind this is now the third week of consolidation, we're building energy up. You're in a market now that is getting ready to move, and it could go either way. Remember, this is now consolidating over a couple of days, or sorry, a couple of weeks. It could go either way from here, and you know what you're looking for. You now know that we're looking for it to get up into these ranges and trend on. We don't want to see a quick move and then it just stabilize sideways. You want to see it drive through these areas if you're going to see a change. Equally, move down. Whilst these have looked like good rejections, we know that these aren't the most convincing of lows. And in fact, realistically, 30.6 is perhaps the area that you're looking for as your opportunity to play this move, not waiting for it to get to the lows. The following week, you're now into the fourth week, and this is where we see this kind of stagnation. It's a market that still continues to struggle for direction. You get this drift down the range early on in the week. We're starting to see smaller ranges as well coming in. Value very compressed, much more balancing type profiles than we have been seeing previously. But even within all of this, you get little pockets of action. And once again, proving the point of this weakness of buyers. News, market goes up, comes straight back off from that same sort of 1865, 1867 area. We get one final attempt higher. Bigger volume, drives higher, sweeps this range, shoots out the top. This is the chance. This is the opportunity to go up. And once again, and in a difference to this one, it doesn't even stick up there. It just gets slammed straight the way back. So now it's a case that sellers are not even just sitting there waiting for buyers to keep trying it. Buyers need this to go straight away. It doesn't. Sellers come straight in and sell it back. And you see again, the volumes on each day are generally highest on the red candles on the down moves. That's where the selling pressure is really coming in. This now is giving you a third attempt up at this sort of 65 to 75 area and no reaction, no continuation. So all this has now led you to an idea that maybe we've got the potential to go down. Clearly can't get the move up. We do keep getting these rejections for around 1830 and then those bigger ones that have come at the beginning of those 2 weeks. But 16 and 00 are weak areas. You don't expect those to hold if we start to set up the move down. So going into the following week, you're now thinking, right, get below 1830. We have possible move down towards 16, 00 and beyond. Beginning of the week, reasonably stable. Balanced type move at the beginning of the week. Not a great deal goes on, and then you start to get a little bit of a drift lower. So this drift lower comes in, and then you have another balanced day. We've seen this before. Go all the way back to the beginning of the month. We've seen this type of balanced action before. We've got the chance now for the inside daybreak and the rip down. So this comes, you get that inside daybreak. The inside daybreak comes at the level around about 1830. This now sets up the possibility of the continuation down. Sets up the chance now to go and have a shot at 16, to go and have a shot at 00. We bounced off 16 the first time. So you get that first shot down, bounce back, form a ledge at 11. 00 is the level where you're expecting the liquidation move, bearing in mind that they were weak lows that were formed because of the time of day that they were done. And that's the kind of thing that gets missed or gets forgotten about if you've not continued to build this story up, because they happened 3-4 weeks ago now. That was the beginning of January. This is now the beginning of February. It's that ability to maintain that story, and by writing these things down, by keeping that score on a day-to-day basis, you don't have to sit here trying to retell yourself the story all the time, but you know it instinctively. You know that you doubt those levels. It's not about understanding every tick and every bit of movement. It's about understanding whether certain references are as strong as one might think that they are. And this is what then allows you to try and play this move, to play that break towards the downside. And so this is it over the course of those few weeks. From the big sell-off, you then get the consolidation week. You then get 2 weeks of energy sort of building up, the stagnation, the failed move higher. And you see it's continuing. This type of action that we saw over here continues, fail to go up. And then as you come into the final week before the break, you then start to see a little bit more of a directional week. And whilst this looks very innocuous, trading in this area here, you start to get this clear early direction, very similar to what you had at the beginning of the first week. Clear early direction sets the tone for trend. We break this uptrend as well, the tone's there. but it still takes another day of consolidation before you then get the action. The action comes late on in the week, but it's the fact that you built the story up and you built towards this that then means that for some traders, the biggest trade of the year came from the building of this picture to play this one move down, and for many, that was it. It's not loads. You're taking 150 ticks out of it maybe. But the conviction to do it, the clarity of what's going to happen, of why you should be doing it, why these lows are not great lows and you can expect the market to zip through them, is simply down to this longer term mapping out of the picture, longer term mapping out of this overall story. This is what you get on the move as well, and it's still not easy until you get to that final stage. When you get down below 18.11, this is the bit to try and play for. A few people did try and play for it from 30 on the way down, and the market does struggle, it pushes itself back up. This is on a 1 minute chart. You then get the opportunity of a break from 21 through the 16. This was the first touch of 16. Through 16, that gives you a trade, but that move there is still only around about 50 ticks. Another sideways consolidation. Then you get another move through 16. And once you break, that's where the opportunity really comes from. And it's once you get through there, that's when the move really comes in. You get the stops from above the level, 1807. That whips you through 00. That gives you 70, 80, 90 ticks, and then you get the continuation onwards from there. That's what I mean by mapping out a story. It means that when you get to this one situation, it's not the biggest of moves necessarily, but it's the conviction that you can have on it based on the days and weeks of story that have led into this, that allow you to have that much bigger conviction, to differentiate your trades, to not play every trade in the same way. You know, the little flag break here is a much more significant little flag break than you might have had at any other point along the way, because of what it leads to, because of the scope of the opportunity that comes up. That's the value of mapping stuff out. We'll start bringing more and more of this in as we move through the weeks. We'll start then also linking order flow to it as well. That way you can start seeing the auctioning help as well as just simply the mapping from a profile perspective. I'll wrap it up there on mapping. We'll bring more of it in. We'll go and have a little look at mapping out current situation as well, so we can see how things can develop over the following week or over the coming week and over potentially the coming few weeks. I'll wrap it up there, guys.